Namaste friends, welcome to Gyanved channel. Today we are here to discuss one of the most important basic principles of investment, how we can get financial freedom with mutual funds. So let's see this video in detail. If anyone is visiting this channel for the first time, please don't forget to subscribe, share it with your friends, press the bell icon so you will get notification to our new videos. Before starting the video, let's wish you a happy Independence Day for Indian independence, and we will have so many happy investment angles in our investment mantra. So friends, everyone around us wants to have a freedom. They want to freedom in their living. They even want to have the financial freedom. So we are going to discuss such approaches or such topics in this video, how we can achieve these details in your investment life. So please don't skip the video in between, watch it till the end. And if you have any questions, please don't forget to mention in the comment box. So why every Indian or any Indian would want a financial freedom? Basically, the financial freedom expresses the strength of your life. Also, how comfortable you can live your life depends on your financial freedom. Also, you will have a confidence when you are living or approaching in the society. Anyone wants to live a life with self-respect. Also, if you have any odds coming in your life, let it be some emergencies, there needs to be a fund which is secure to tackle such issues. That's why you always need a financial freedom. When it comes to financial freedom, how we can achieve it? There are multiple ways or multiple aspects of the same topic. So let's see. Insurance. Why insurance is needed? We basically need two types of insurances. Basically, there are multiple types, but at least anyone should have two types of insurances. One is with the life insurance and other is the health insurance. So we have other videos also on similar topics. So you just subscribe and you can go through the channel details. Also, you should have a cash or cash equivalents. Why this is needed? In case you have an urgent requirement or any emergencies, you should be able to tackle this problem with this cash or cash equivalents. Also, you should choose your investment opportunities so that your fund or the wealth can grow to meet your future expenses. So we have some products which gives the fixed returns. Then real estate is also some of the preferred ways. Some people even invest in gold, which is not fixed, but over the time it has been considered as secure. Also, there are market linked investments opportunities also. So we'll take these things into detail. So when we consider financial freedom as a country or as a citizen, the basic measurement comes from the economic activity, how our economy is growing. As you know, India is one of the fastest growing economies. Also, India is having a high GDP growth. So this also matters when we consider whether the citizens are financially free or not. Also, how much is the purchase power of the citizens? How much they can spend on their consumptions or their other activities. Also, the living standard also gets improved as you grow your financial freedom. Also, healthcare is also a major thing which is considered whether the country is strong in terms of financial freedom. So let's focus on the investment angle of the financial freedom. So there are two rules. Rule number one is don't lose your money. Whenever you are considering any product, you should calculate the risk whether there is any possibility to lose your money. If yes, how much? Second rule is that don't forget rule number one. Whenever you are thinking of investing anywhere, you should first take a look at these two rules and then take your decision. Now further, let us go into deeper on this investment angle. When we consider market as one of the investment opportunities, there are different types of investors that comes into picture. One thing is that foreign investor, which invest in some country or economy which they feel is growing and they would get a return. But as you know, friends, foreign investors many times are considered as fair weather friends. So when weather is good, they will come. If weather is bad, they will take back their money. Second type of investors is the domestic institutions. So these are the institutions like financial institutions, let it be bank or mutual fund industries. These are kind of examples which invest into the market and then they will distribute their returns to their investors or their shareholders, we can say. Third type, which is most important in our discussion, is the retail investors. Our videos are mainly concentrated to retail investors and their interests. So we are giving many such fundamental researches. So please don't forget to subscribe this video. To achieve the financial freedom, let's not forget that whenever the foundation is strong, then only the structure will be stronger. So don't forget this principle whenever you are choosing any investment opportunities. Some foundation principles of financial freedom as the vision. The vision tells what is your financial goal, how much time frame you can spend in this one, and what are the instruments you are using. Also, you should have the saving habit. Why this is necessary? Because every penny counts in long run whenever it comes to the investment returns. Also, the systematic investment is the best way to invest throughout the world. Whenever you have a systematic or disciplined investment, there is major chance that you will have a fair returns. Also, user or the investor should be aware of the calculated risk what he is taking when he choose a specific instrument to be invested in. Also, investors should be aware of the various investment options that he can choose. So there can be many options which can give you good returns, but their risk levels are different. So it is important you should understand that before you start investing. When we are achieving the financial freedom with the help of mutual funds, understand this picture. The tree needs a considerable time to grow and starts giving up fruits. Same thing is with the mutual funds also. So how you can use mutual funds? You can do the lump sum investment, you can do systematic investment plan, you can have a systematic transfer plan. Suppose you have some amount in lump sum now, and over the time you can move this into the equity or respective funds. There is one more thing as systematic withdrawal plan. So you'll get another video on this topic soon. So please be with the channel. Whenever anyone wants to invest in mutual funds, there are so many choices, say so many funds, so many companies are there into market. So you have several options, and we have many other videos also to give advice on these ones. So we have liquid or debt funds, then you have hybrid or balanced funds also. You can invest in large cap funds, you can invest in mid cap or small cap. Even there are micro cap funds also available. Also there are flexi cap funds, index funds, there are many types of funds. So investor can choose based on the risk ability and the vision. So financial freedom needs certain investment mantra to be followed. First thing is that any investor should match their risk ability. Then only they should take the decision to invest in the market. Second thing, it is always better you have discussion with your investment advisor and take a right call. Otherwise, you can do on your own research also. Also, diversification is also needed or it is advised because it reduces the overall risk in your investment. Also, you should consider the good enough investment horizon for each of the products because every product has different returns when you consider different time periods. Even if you say fixed deposits. If you invest for 10 years, 20 years, over the times the interest rates also gets changed. So you should consider the investment horizon also before you invest. One of the key principles of financial freedom is the time you give for your investment to grow. So don't try to time the market. What does it mean? There is a beautiful quote from Peter Lynch, who is legendary investor. So he says that, okay, investors have lost more money anticipating the corrections or the waiting for the correction than they have lost in the correction themselves. So we will have some examples also, friends. So watch till the end. So now question comes, how much time you need to give for a specific mutual fund or any specific investment tool. So it's not fixed one, but I have calculated it some average, you can say. If suppose you have some time more than a month or so, you can park your money in liquid or debt funds. So you can choose these funds for 1 year to 3 years roughly, but it depends on how much risk you want to take. Also, suppose if you have a time greater than 3 years, so it is better you choose hybrid or balanced funds. If you have time more than 5 years, let's say, I would prefer to choose flexi cap funds or large cap funds. So there are some blue chip funds also. Suppose if your investment goes beyond 7 years or 10 years, so then there is a scope that you can think of mid cap, small cap, or micro cap also. So we'll come with the other type of funds also. This timeline is not fixed for everyone. It depends on your risk potential. So always think of how much time you will be able to spend for your investment to grow. Here is one example why time is an important factor. So we have taken a Nifty 50 high time chart. So you have seen here that Nifty has given 1725% return so far. So this is taken as of 4th of August, friends. So think of, so there are many ups and downs in this chart, you can see, and we have highlighted here one specific period, 1 year period, let us say. Here Nifty 50 has corrected more than 50% easily, you can see, friends. So if you consider this part of this chart, this is really scary. One more scarier part you can see in when the COVID wave 1 started hitting the world and market went down here. But if you are still seeing the overall chart, it is growing side. So that is the reason the time is one of the most important factor that you consider in the mutual fund or market investment. Again, we have considered the risk ability of the investors also, right? So we have seen here a comparison between different types of funds. So you have seen here the red one is showing as the one sample fund. We have taken here the Kotak small cap fund. It has given the highest return in last 5 years. But see, friends, it is showing the higher, but same time if you have seen the risk potential, here the volatility also was highest in this fund. So if you are not a user who are used to the volatility or not a high risk investor, you should not consider such type of funds. So if we have seen Canara Robeco, which is a large cap fund, so here it has given little bit lesser returns, that 113% in 5 years, but still you can see the volatility is comparatively lesser. Also, people can opt for the index funds also, which will match to the Nifty 50 or little closer to that horizon. Please subscribe so you can get the notifications for our new videos. So Gyanveda will keep coming with any such investment ideas. Please don't forget to take investment advisor advice before you start investing. And happy investing. Namaste. Thank you. Happy Independence Day.